Hello and welcome to everybody on today's session. My name is David Kelly. I'm the Executive Director of the British Chamber of Commerce here in Singapore, and a very warm welcome to today's webinar, A United Kingdom Outlook, the UK Budget Review. A huge thank you to our event partners, Select Investors, for supporting this important topic today, and also for your continued support of the Chamber. It really is muchly appreciated. There was much speculation in recent months of a one-off wealth tax on UK residents, of an overhaul of inheritance tax system and capital gains tax systems, and of how the government might continue to raise money from pensions, property and business corporates as well. Following the budget release on the 3rd of March this year, we're joined today by three amazing panellists who I'm delighted to introduce. We have Her Excellency Cara Owen, the British High Commissioner to Singapore. A warm welcome to you, Cara. Mark Addy, Director for International Tax at KPMG. Welcome, Mark. And of course, Martin Rimmer, Head of Tax at Select Investors, as they dissect the budget and what it means for you. I'm absolutely delighted to be moderating today's session and have the great pleasure of inviting our speakers. So to get us started, a very warm welcome to the British High Commissioner, Her Excellency Cara Owen, to set the economic landscape. Cara, thank you so much for joining us today, and over to you.
Thank you very much, David, and hello to everybody who is online and to my fellow panelists. It's really good to be here talking to you about the UK economy and the budget. I'm going to sketch out some top-level reflections basically on what the budget is all about and what it means for our economy in the UK. I very much look forward to hearing the other panellists dissect it in a bit more detail and stand ready to respond to any questions that you would like me to respond to. So we're now at the period where we are beginning our path to economic recovery in the UK, and this budget therefore comes at a really pivotal time. The UK economy and the global economy is not yet out of the woods by any stretch of the imagination. So we're already thinking in this budget and in government policy about what we need to do in terms of near-term support. But at the same time, I think we're all really conscious of the fact that it's paramount that we position ourselves well for long-term growth, ensuring that we build an economy that adapts to the profound changes that COVID-19 has set in motion. As the Chancellor put it on March the 3rd, when he launched this budget, this is a budget that meets the moment. And I'm delighted that with Mark and with Martin, we'll be able to explain the budget and its impact on corporations and also on individuals. But I'll start by providing a brief overview of the UK economy and highlight some of the major announcements from the budget itself. The first thing to say, I think, as we all know, we need nobody to tell us this, but 2020 has been a really challenging year. COVID-19 has resulted in the world's deepest recession since 1929. Global trade flows fell by 9%, global FDI flows by 42%, and air travel by a whopping 66%. Globalization, as I have known it all my life, was effectively put on pause. The UK is one of the most open economies in the world, and so these changes have resulted in substantial economic challenges. Our economy has shrunk significantly, figures of 10%, and unemployment is expected to rise up from where it is at was at 4% before the pandemic struck. And I'll talk later about whether or not that rise in unemployment is going to be quite as severe as we once feared. As here in Singapore, the crisis has disproportionately affected certain sectors in the economy. Consumer-facing sectors continue to be the hardest hit. For example, spending on restaurants and hotels remains about 42% lower than in the fourth quarter of 2019. In response, the UK has implemented one of the most comprehensive fiscal support packages in the world. The IMF called it the UK's economic plan aggressive, unprecedented, and successful in holding down unemployment and business failures. The result, of course, is that our borrowing is the highest it's been outside of wartime. It's going to take the UK and the whole world a long time to recover from this extraordinary situation. But the point about this budget is it's aimed at putting us in making sure investments happen in exactly the right areas to enable us to bounce back as quickly as we can. So today, with the vaccine rollout well underway in the UK and over 20 million people now having been vaccinated at least with one dose, the UK has been able to set a roadmap for the cautious reopening of the economy. The budget delivered by the Chancellor on March the 3rd builds on this roadmap and sets out the next phase of our fiscal support. It does so by providing continued security and certainty for the hardest hit sectors and workers across the UK, but at the same time supports the foundations of long-term growth through promoting a green and investment-led recovery. I want to highlight a few of the main announcements. The immediate priority continues to be supporting those who've been hardest hit, with extensions to furlough, self-employed support, business grants, loans, duty freezes and VAT cuts. The UK's signature furlough scheme, which has already supported over 11 million jobs across the UK, has been extended until the end of September. In total, this fiscal package has led to a total fiscal support of over £407 billion. That's about 20% of our GDP this year and next year. Attracting investment remains a top priority, particularly from international investors. Building on the establishment of the Office for Investment late last year, and in support of Building Back Better, the Chancellor has put investment at the centre of the budget and economic recovery. There are three key pillars to this: infrastructure, skills and innovation. As we all know, high quality infrastructure is crucial for economic growth, boosting productivity and levelling up across the entire country in the UK. The UK is starting this with £100 billion worth of capital investments next year in broadband, in roads, in rails and cities. Over 5 years, the investment will amount to £600 billion, as outlined in our recent National Infrastructure Strategy. At the same time, and with the UK hosting COP26, the United Nations Climate Conference later this year, we're clear that infrastructure build-up needs to be green. The new UK Infrastructure Bank, based in Leeds, will crowd in private investment to accelerate progress to net zero. The UK will also issue its first green sovereign bond later this year to finance green projects. A new port infrastructure will be built to support the next generation of offshore wind projects in Teesside and Humberside. Just last week, General Electric announced details for their planned wind turbine plant at Dogger Bank Development, the world's largest offshore wind farm. Skills. The best way to improve people's life chances is to give them the skills to succeed. The UK has a strong foundation of advanced skills, and that's one of the reasons why employers and investors are so attracted to the UK. But we think there's room to improve on technical skills. The government's transforming further education, encouraging lifelong learning through the Lifetime Skills Guarantee, and building an apprenticeship revolution. The budget goes further. It sets aside a further £126 million for new traineeships and doubles the incentive payments given to businesses to £3,000 for all new apprentice hires of any age. And I think there's a real global aspect to this as well. The government has already announced a successor to the Erasmus scholarship scheme, which will see people UK students not just focusing on going to Europe, but also fanning out across the globe to get international experience. Third is innovation. The UK has a world-leading research base, which will be boosted by the government's significant uplift in R&D investment and the creation of the Advanced Research and Invention Agency to fund high-risk, high-reward research. Building on the success of previous stage, a new £375 million future fund will support promising startups. We also want to attract the most promising talent, and that is why the budget introduces a new unsponsored points-based visa to attract best international talent in science, research and tech. Further, the budget supports our small to medium-sized enterprises to grow through two new schemes to boost their productivity. Help to Grow Management, which is a new management training offer, and Help to Grow Digital, a new scheme to help 100,000 SMEs save time and money by promoting productivity enhancing software, transforming the way they do their business. Beyond these three pillars of infrastructure, skills and innovation, there are a couple of other new and exciting policies that I'd like to highlight. I believe these will be highly supportive for business investment also. The first is a really groundbreaking policy. Beginning in April 2021, a new super deduction will cut companies' tax bills by 25 pence for every pound they invest in new equipment. This means that they can reduce their taxable profits by 130% of the cost of that equipment. And it makes UK's tax regime for business investment truly world-leading, lifting us from 30th in the OECD rankings to first, and worth £25 billion during the first 2 years it is in place. This will be the biggest business tax cut in modern British history. The second announcement is the announcement of 8 free ports in the UK. A core component of the UK's levelling up agenda, free ports are special economic zones with different rules to make it easier and cheaper to do business. They're well established internationally, but the UK is taking a unique approach that will benefit regions across the entire country. Our free ports will have simpler planning to allow businesses to build, infrastructure funding to improve transport links, cheaper customs with favourable tariffs, VAT and duties, and lower taxes with tax breaks to encourage construction, private investment and job creation. Can you just check the... What do you mean? It's running low on energy. Public finances. At the same time as preparing the foundations for the future with bolder investment plans, the Chancellor was honest with our public about the need to get public finances back on track, giving people and businesses the certainty they need for the future while not raising rates of income tax, national insurance or VAT. Income tax, personal allowance and the higher rate thresholds will rise next year as planned and will then be maintained at that level until 2026. Nobody's take-home pay will be less than it is now, and the UK's allowances remain the most generous of any G20 country. To balance the need to raise revenue with the objective of having an internationally competitive tax system, the rate of corporation tax will also increase to 25%, but will remain the lowest tax rate in the G7. In order to support the recovery, that increase will not take effect until 2023. I know that Mark and Martin are going to be discussing tax implications in more detail. The budget sets the UK on a path towards recovery. The NHS, deserving of massive praise, has had an extraordinary success in vaccinating over 20 million people across the United Kingdom. And combined with our comprehensive economic response, this means the Office of Budget Responsibility are forecasting a swifter and more sustained recovery than previously expected. The OBR now expect the economy to return to its pre-COVID level by the middle of next year, 6 months earlier than we previously thought. They forecast that the UK economy will grow this year by 4% and by 7.3% in 2022. And they've also said that our interventions to support jobs have worked. In July last year, they expected unemployment to peak at 11.9%, but today they forecast a much lower peak at 6.5%. So while full recovery will take some time, not just for the UK, but for the global economy, there are real reasons for cautious optimism. For investors in the UK in particular, this budget offers reassurance in the near term, at the same time as highlighting the UK's ambition for the long term, backed by bold new policy moves. It's a budget that sets the UK on course for a strong, sustainable and inclusive recovery, promoting the levelling up agenda across the whole country and expediting our move towards a net zero society. Thank you very much.
Thank you so much indeed, Cara. Thank you so much for sharing some of those sort of near-term supports, but also positioning for the long term as well. And just before we move on to the next speaker, if I could ask, you mentioned that the UK is one of the most open economies in the world. And when you look at the budget, what elements most stand out to you as the High Commissioner to Singapore?
Hi, sorry, I'm back. I'm having technical issues. Sorry about that, David. So I think for me, some of the things that are the most striking are our utter commitment to making sure that this is a green recovery, and that we use this period where people are thinking again about which sectors are going to lead our economy in the future, what are the investments that we need, what are the skills that we need in order to really embed a green recovery.
Super. Thank you so much. And just for our audience online today, please do post your questions into the Q&A facility at the bottom of the Zoom as well, and they'll be addressed following the presentations. I would now like to invite Mark Addy, Director International Tax for KPMG, to share his takeaways on the business and corporate tax elements of the budget. Mark, lots to discuss here. Really looking forward to your presentation, and over to you.
Thank you, David. Yeah, and morning or afternoon, everyone. And as David said, I'll be taking you through some of the key business tax updates from the spring budget. I thought before we get into the key announcements, and Cara did touch on a few of those, it'd be helpful just to recap on some of the key themes coming out of budget 2021, and the kind of the objectives of the government in kickstarting the recovery from what's been a difficult past year. So there are three key themes. The first was to continue to support people as we hopefully emerge from this pandemic. And Cara mentioned that there would be continued furlough support, self-employed support, and also funding support for businesses in certain sectors. The second is to repair public finances. There's obviously been a huge amount of expenditure in the past year, and we now need to start thinking about how we repay some of that, and which particular groups will be responsible in the main for repaying that. And the third is to start growing the future economy. And you'll see that as we talk through some of the business tax measures, that there are a number of measures there which are designed to encourage investment in the UK, but also to assist businesses that have perhaps had a difficult 2 or 3 years in recovering some tax that they may have paid in previous years. And it's interesting, when Martin and I presented this same webinar last spring, we saw a budget that was generally fairly light on corporate and business tax measures. And generally speaking, when you have a budget that is light on measures for companies are pretty happy with that. They prefer the status quo, particularly large companies. It's a slightly different story this time. It's a bit of a mixed bag, but it's certainly not all bad for large companies. There's a number of investment incentives that are out there. But Helen, if you just flick onto the next slide, we'll start to talk through some of the key announcements. So the big headline grabbing announcement from this budget was obviously the increase in the headline corporate tax rate to 25%. Now, the increase itself was not particularly surprising, but I think the increase to 25% was higher than most people had expected. I think most commentators and those in the profession were expecting a rise of somewhere around 23%. So 25% being higher than expected. But having said that, there will be a small profits rate which will be maintained at 19%, and that applies to profits of below £50,000. That will be tapered back up to 25% for profits between £50,000 and £250,000. So there'll be some complex marginal rate calculations that tax professionals remember from a few years ago for companies to calculate. To put this in context, this is the first time there's been an increase in the headline tax rate since the 1970s. And certainly what we've seen in the past 5 to 10 years is very much a global trend for corporate income tax rates to reduce. Some of the larger economies, the US, famously decreased their headline corporate tax rate as part of the Trump administration. There are now strong suggestions that will increase back up to closer to what it was prior to that under the Biden administration. Japan and France had also been reducing their headline tax rates, but I think what we're going to start to see now is more of a trend on a global scale for headline tax rates to increase again as a result of what's happened in the past year. Until recently, the UK was heading down towards 17%, with the suggestion being that it was trying to become kind of a Singapore of the EU. That's been reversed, and like I said, I think we'll see a general trend of increasing headline corporate tax rates, and an expectation that it may be large corporates and big businesses that are expected to pay for some of the spending due to the pandemic over the past 12 months. Couple of other announcements. So also unsurprisingly, the diverted profits tax rate will increase to 31% from 25%. The diverted profits tax rate this is basically a tax that was introduced to tax profits of multinationals that had been deemed to be artificially diverting their profits outside of the UK. So for example, where they had significant economic activity in the UK, but weren't deemed to be paying or allocating sufficient profit and paying enough tax in the UK related to those activities. So that's now been increased in line with the headline corporate income tax rate up to 31%. And that's most definitely an area that we've seen HMRC aggressively pursuing since its introduction to make sure that everyone is paying their fair share of tax in the UK. And then one other announcement relevant for corporate income tax rates was the 8% surcharge for banks. Now this is an additional tax on banking profits, was introduced in 2016. And the Chancellor announced that there would be a consultation on the 8% surcharge for banks to assess whether or not this is resulting in too high a tax burden for banks. When you increase this with the increase in the headline tax rate to 25%, and also the existing levy on bank balance sheets, this does really leave a quite significant tax burden for banks. And I think that the Chancellor's concern here is that they want to ensure that the UK is competitive with both other EU countries, North America, and also some of the financing hubs in Asia Pacific that tend to have much lower tax rates. This is obviously a politically delicate area, probably not one that will get too much sympathy from the public, but I think the UK and certainly the current government is aware that the UK needs to remain competitive, and hence the commencement of a consultation in respect of the 8% surcharge. Go to the next slide, Helen. Okay, so they were the big headline grabbing rate increases. Cara touched upon a couple of the investment incentives. There was also an enhancement to the UK's loss carryback rules. Under the current rules, there is an unlimited 1-year carryback of losses to offset against your profits of the prior year. Similarly to Singapore, the UK announced an enhancement to its loss carryback rules, much more generous in amount than Singapore's announcement. And this will see a new rule which allows up to £2 million of losses incurred in 2021 and 2022. They can now be carried back for up to 3 years. So if you have businesses that have suffered throughout the pandemic and have incurred significant tax losses, they can now carry those back to 2018, 2019, 2020, when they may have been more profitable, to offset the profits in those years. And that gives them the potential to recover up to £760,000 in tax. So there's a real cash flow benefit of allowing the enhanced loss carryback. So really focused on companies operating in sectors that have suffered throughout the pandemic. Was also, and Cara did certainly mention that the super deduction for investment. So this is a first year capital allowance of 130% on plant and machinery acquired between April 2021 and March 2023. And like Cara said, this is effectively a 25p tax saving for every £1 of expenditure. So really trying to encourage investment in the next 2 years before we see that headline corporate income tax rate increase. There's also an increase to the first year rate on special rate assets. Special rate assets include things like long life assets, thermal insulation of buildings, integral features of buildings. The current annual rate for that is 6%. That will increase to 50% in the first year. So it really gives you a chance to accelerate the tax benefits related to investment in those kind of assets in the period between April 21 and March 23. Okay, next slide, please, Helen. Another big announcement as part of this budget was the fact that there would be 8 designated free ports across England. These are effectively zones which have favourable VAT and customs duty treatment before you then import or you move the goods into other parts of the UK. So for those interested, the 8 zones that have been designated are East Midlands Airport, Felixstowe and Harwich, the Humber region, Liverpool, Plymouth, the River Solent, the River Thames, and Teesside. And the objective of this primarily is to try to regenerate some of the more deprived areas and ensure a reasonable spread of these free ports around England. There were 30 submissions, so this is clearly a very popular initiative, and the submissions came in, or the bids came in pre the budget announcement. That was narrowed down to 8 regions that may be extended. We also expect Scotland, Wales, and Northern Ireland to announce their own policies in the next couple of years in relation to free ports. And there are various tax benefits that will be made available to free port companies, which include enhanced capital allowance rates. There'll be 100% allowance for any plant and machinery expenditure on top of the 130% allowance. So once that expires, you will continue to be able to have 100% first year allowances on plant and machinery expenditure. There will be a 10% relief on structures and buildings. That's compared with currently a 3% annual rate for structures and buildings allowances. There'll be 100% stamp duty, land tax, and business rates relief up to 2026. And there will also be temporary employers' national insurance contribution relief between 2022 and 2026. So really trying to encourage companies to either relocate or locate in free port areas to generate economic activity and jobs in some of those areas where unemployment is high. Okay, next slide, please, Helen. So a few other measures worth mentioning impacting businesses. First is that the 5% rate for hospitality, holiday accommodation, and attractions will be extended to 30 September 2021. That will then be increased to 12.5% up to 31st March 2022 before going back to the standard rate of 20%. That's the idea, is that there's no cliff edge for these industries, so that they continue to receive support as we emerge from this pandemic, without support just immediately disappearing. So the idea is that it's tapered down and gradually decreased over time. Similarly, business rates relief for hospitality, retail, and leisure will be extended until 30th June 2021. That will then be tapered down to 66% relief up to 31st March 2022 before they are then required to start paying the full rate again, in the hope that we have fully emerged from the pandemic by 31st March 2022. Another announcement which was snuck in there was the fact that the withholding tax exemption for interest and royalties paid to associated EU companies will be abolished from 1st June 2021. This is perhaps not hugely surprising, but I think came a little bit quicker than many were expecting, and effectively stops EU companies from benefiting from tax exemption on royalty and interest income derived from the UK. They'll now have to look to the UK's tax treaties with their jurisdiction to assess what the appropriate withholding tax rate is on these types of payments. It will certainly result in an increase in administration for companies, as there'll be an additional filing to do, but it will also require multinationals who are either financing UK companies or licensing intellectual property into the UK. They'll need to assess whether or not this results in additional taxes on cross-border payments, so relevant for EU companies that are licensing or financing UK entities. A couple of other things not mentioned on the slides, but certainly worth a mention. So there were a number of tax updates mentioned in this budget. There is also going to be a separate, what's been touted as tax day or tax consultation day on the 23rd of March. Where various consultations will be launched, with the expectation that will focus more on longer term tax policy, trying to find something that is sustainable in the longer term, and that will allow consultation with various different industries. There's also a number of green initiatives which Cara touched upon. I think it's fair to say it wasn't the main focus of this budget, given that the focus is still on emerging from this pandemic, but the idea is that we emerge with a focus on environmental initiatives. So the Infrastructure Bank will fund public-private infrastructure investments related to climate change. And last year's spring budget also announced a plastics tax, and that looks set to be introduced by 2022 based on the tonnage of unrecycled plastic waste that businesses use. So I think all in all, not a bad budget for businesses, aside from the higher than expected increase in the corporate tax rate. There are a number of short to medium term measures to encourage investment and also help companies to save tax or recover tax that they may have suffered in prior years. That's all from me.
Thank you so much indeed, Mark. Thanks for sharing some of your insights on the business tax updates and some of the sectors that have been impacted as well. You mentioned not a bad budget for businesses, which is good. What can or should businesses read into the headline increased tax rate of 25% as a major part of the announcements? What should they be sort of really reading into from that perspective?
I think on that, David, it seems like the UK government expects large businesses to bear the brunt of the expenditure in the past couple of years. Not a huge surprise, and I think this will be consistent with the approach that we see in a number of other jurisdictions. Also important to remember that there are a number of short-term or medium-term incentives, so investment incentives between that period between 2021 and 2023. So I think, while the headline increase was higher than many would have expected, I suspect this will be the start of a trend across a number of countries to increase their headline corporate tax rate. So overall, yes, they will have to bear a significant part of that cost, but I don't think businesses will be hugely surprised by that.
Okay, thanks so much indeed, Mark. Thank you. We'll bring you back into the Q&A a bit later. Finally, I'd like to invite Martin Rimmer, Head of Tax at Select Investors, to share his analysis of the personal tax elements of the budget. Martin, a very, very warm welcome to you, and over to you.
Thank you very much indeed, David, and a very warm welcome from me to all of you who are attending today, and a warm word of thanks to the team at the British Chamber of Commerce, Mark Addy, and of course Her Excellency Cara Owen for attending our talk today. The budget was fairly light on personal tax matters. Unusually for me, for those of you who know me, I do like to talk, but I've only got 4 slides today. So I should be able to whip through this fairly quickly. I think the first thing to say is that I think you may all be aware that the Chancellor had previously announced an extension, a stamp duty land tax holiday, as he called it, on the first £500,000 of cost paid towards the purchase of a residential property, and that was scheduled to come to an end on the 31st of March this year. He has decided to extend that until the 30th of June, and then rather than having a cliff edge where it just stops, he's going to taper it back. So on the 1st of July, that initial banding drops from 500 to 250, and then from the 1st of October 2021, that drops back to the original rate of £125,000. At the same time, however, on the 1st of April this year, the government is introducing a non-resident surcharge to stamp duty land tax, which basically adds 2% to each of the relevant rates of tax. So here you can see on the screen we have the rates as they will apply up to the 30th of June 2021. There are 2 types of rates of stamp duty. We have standard rates, where perhaps it's the very first property in the world that you're purchasing, or it's a replacement of a main home. If it's neither of those things, you have to pay at accelerated rates, which adds 3% to the standard rates. If you're non-resident in either of those categories, it adds another 2%. So you can see on the right-hand side there, we have the non-resident rates that apply. So you can see, in fact, for the first £500,000 of purchase price paid, if it is your only property in the world that you are buying or a replacement main home, you do actually pay 2% for completions from the 1st of April, and 5% if it's not in that category. So for the purchase of a £1.5 million property, you can see quite a vast differential there in stamp duty land tax payable. Next slide, please, Helen, if you don't mind. Thank you. So if we then look at the rates as they will stand from the 1st of July to the 30th of September, where that £500,000 holiday rate drops to 250,000. Again, the actual stamp duty land tax rates don't change, but you can see how the cost of a £1.5 million property rises very slightly. We've taken £250,000, we've moved that from the low rates up into the higher banding, as you can see. And then from the 1st of October 2021, that concessional relief comes to an end, and we simply go back to the rates and the allowances that they had previously been. So the first £125,000 of purchase price attracts the lowest rates for stamp duty, and then we work our way through those graduated tax rates. And again, you can see again the differential in the overall cost depending on whether you're resident paying at standard or higher rates, and non-resident paying at standard or higher rates. Just one point to make, obviously, I guess the majority of us listening to this talk are non-resident. The definition of residence for stamp duty purposes is not going to be based on the statutory residence test. It's going to be based on a simple 183-day test. So, you know, if you're looking at purchasing in the UK, we have to look backwards by 1 year and have you hit 183 midnights in the UK, and we have to look forward by 365 days and have you or will you be hitting 183 midnights in the UK. So if you're looking at purchasing and you need some guidance on how these rules apply to you, do let me know. And the other point I'll just make about this is that if you have already exchanged contracts to complete on a property and the completion only happens on or after the 1st of April 2021, you do not pay the non-resident rates unless the contract has changed. So that's really all there is to say about stamp duty land tax. Helen, if you could just move to the next slide, please. In terms of personal tax rates, the government had made a manifesto pledge not to increase the rates of income tax, so fine, we're glad to hear that. But what they have decided to do is to leave all of the allowances unchanged, with for most of them, in fact, with effect from where they stand right at the moment. So the personal income tax allowance is currently £12,500. That will go up on the 6th of April to £12,570 and will then remain unchanged for 5 years. The same will happen with the amount of income that's subject to tax at the basic rate. That's currently £37,500. That will rise very slightly to £37,700 and then also will remain unchanged for the following 5 tax years, which is unprecedented. I remember during the just after the financial crisis, they decided to keep the income tax allowance unchanged for 2 years, but we're looking at 5 full years here. And that also, the upper earnings limit is the limit at which lower rates of national insurance start to get paid on earnings. That really won't impact us here, but is relevant. Put together, those measures are expected to raise a little bit more than £19 billion cumulatively over the period to the 6th of April 2026. The annual capital gains tax exemption is remaining unchanged and fixed until the 6th of April 2026, raising just £65 million. It almost makes you wonder why they're doing that. But anyway, the lifetime allowance is the maximum amount of a value that you can hold in a UK defined contributions or defined benefits pension scheme, above which tax charges can arise as and when the pension is accessed in certain ways. Currently set at 1.73 million, the intention was to link that to CPI, the Consumer Prices Index, but they have decided also to freeze that for the next 6 years. That they expect to raise an extra £1 billion in revenue. So you put all those things together, about 22 billion pounds. The inheritance tax nil rate band, it's the amount of wealth that can transfer without an inheritance tax consequence, has actually been set at 325,000, would you believe, since 2009. So no surprise that that is also remaining frozen at least for the next 5 years. And they're expecting that to raise about £1 billion. So they're looking, based on these announcements to the public, the great British public, to raise about £21 billion through the income tax, capital gains tax, inheritance tax systems. Compare that to the projected additional tax takes as a consequence of putting the corporation tax rate up to 25% from the 1st of April 2023. So you can see where the priority is in terms of raising those revenues. Can I have the next slide, please, Helen? Thank you. And just a couple of other things. You may be aware that it is possible to make certain type of investments into the UK which carry certain UK tax reliefs. We have something called the Enterprise Initiative Scheme, the Seed Enterprise Investment Scheme, and the Venture Capital Trust Scheme, where in essence, if you subscribe to new shares in companies that qualify under these schemes, then you can enjoy a reduction in your income tax bill of anywhere between 30 to 50% of the amount subscribed. And they had a couple of years ago introduced something called social investments tax relief that operates really in very much the same way. So a subscription for new shares in enterprises that add to the social good, albeit on a profit-making basis, you can claim an income tax deduction for that. And also, once you've held the shares for 3 years, you can then sell them and would be exempt from capital gains tax if you're a resident in the UK. Now, that was meant to come to an end on the 5th of April 2021, but the government's announced that will now be extended for at least another 2 years. So it's important for you to defray UK income tax charges through investment. Then there is this additional route for another 2 years. Secondly, the government has also chosen to consult or to introduce, in fact, a new regime for self-assessment penalties. So we all know that we have to get our tax returns in by the 31st of January, and we also have to get our capital gains tax disclosures done within 30 days of the completion of the sale of the property. And that we get those dreaded £100 fines, and they can go up and up and up and up. Well, they will be introducing, with effect from the 6th of April 2024, a points-based system. You can basically have 2 strikes without financial penalty, but if you then have a further infraction, they will then start fining you £200 subsequently. If you keep a good record for 2 years, so your points go back down to 0, and they're also going to be introducing new late payment penalties. So overall, a fairly light budget, lighter than we expected. We were expecting some movement on inheritance tax. We were expecting some alignment in the rates between capital gains tax and income tax. We were also expecting, potentially awaiting some form of wealth taxation. All of that was conspicuous by its absence. But as Mark mentioned before, we had a consultation deadline, consultation day on the 23rd of March. The Chancellor was conspicuously silent on that in the actual budget speech. So as I preface this to our clients, we've had budget part 1 on the 3rd of March, and I think we're going to be having budget part 2 on the 23rd of March, and we will be, of course, briefing you all on those things. So that's all I have to say. They're fairly light. I think, David, over to you, my friend.
Thanks, Martin. If we can just keep you there, brilliant presentation. Thank you so much. I know you just highlighted it at the end. I think, I understand that there are a number of consultation documents which will be published on the 23rd of March, or budget part 2, as you mentioned. Do you have any sense at all of what these might look like from a personal tax perspective that you can share with our audience today?
Yeah, sure. I mean, it's a little bit like crystal ball gazing, but quite a lot of people in the tax community are gazing into the crystal ball and are getting more or less the same answers. So we are expecting some fairly significant movements on inheritance tax. There have been a number of reports published by the Office of Tax Simplification. I think that was the office that published them. The government's not obliged to follow those recommendations, but they do take them seriously. And the inheritance tax system is widely felt as being antiquated, and I think we may well see some form of reform in terms of a taxation on gifts over an extended allowance, but potentially accompanied by a reduction, would you believe, in the rate of tax on death estates. They've been widely talking as well about aligning the income and the capital gains tax rates. Ironically, that would take us back to where we were in the late 1990s. Actually, I remember in the day those two things were aligned, and there used to be relief for the increase in inflation. We could well see that. I've also heard rumours, and this speaks very slightly into Mark's territory, of potentially an alignment of tax rates between individual tax rates and corporate rates where there are private investments held in companies. Time will tell. Lots of people buy their UK properties through investment companies in the UK. I don't know about you, David, but both Mark and I are going to be completely busy on the 23rd of March, and probably for at least a couple of weeks afterwards. So I've actually been holding back from giving our clients detailed inheritance tax advice pending these announcements.
Thank you. Thanks so much, and thanks also for your presentation. I'm going to welcome all of the panel back because I think that's been three brilliant presentations. So the government lens, the corporate lens, and the personal tax lens, which has been absolutely fabulous. And I've started to see some questions come through. So please, all of you in the audience, if you do have questions for the panel, please pop them through. But Cara, if I can sort of come back to you, there appears to be some themes in the budget that are very similar to Singapore's key focus areas around skills and innovation in the green agenda, and certainly with the news of the UK and Singapore, elongating the SG-UK partnership for the future, which was really exciting. How are countries working together in these areas, and certainly from the news that we're picking up from the budget, there seems to be a bit of crossover, which makes a lot of sense. Can you sort of put some flavour onto how the countries are working more closely together in those areas?
Yeah, thank you, David. I mean, to me, it's really, really striking, and in a sense, not surprising, because we are two similar kind of knowledge-based economies that are looking at developing both our green credentials. I think the UK has some of the strongest green credentials in the world at the moment, one of the strongest private sector bases of any country around sustainability, green, renewable energy, green finance, etc. So you can see that absolutely layered through both our policies and the Singapore government's budget and its Green Plan 2030. So that is very striking. I think skills collaboration is also really striking. Singapore has got a very famous approach, kind of skills future, where it's really trying to make sure that the skills that the economy needs in the future are going to be absolutely developed from the ground up, but also in lifelong learning. And you can see a number of the policy initiatives that have been taken through this budget and have been funded look really, really similar to that. We are having good conversations with the Singapore government around the skills agenda, and there's some areas I think where we can really share quite a lot, even down to thinking through curricula, if you like, of the kind of things that we are training people up to do. There's already some significant sharing. So, for example, the Imperial University SMU hookup on green finance, upskilling for finance professionals. That's a classic example of a case where we can be having two of our premier institutions working together to increase the skills base. And then I think innovation is the other area. Quite how much the government is incentivising investment, private sector investment in innovation, and how much it is supporting development of innovation and translational capability within UK deep research, but also within corporates as well.
Guys, thank you very much. Mark, if we can bring you into the conversation, how do the announcements position the UK from a global tax competitiveness standpoint? I mean, you talked about the UK was heading down to a 17% tax rate, but not so much anymore, hitting larger companies. There must be an impact there. But also, I think this is linked to Duncan's question that he's put through as well in terms of the corporation tax rise. Is it temporary until the UK balance sheet looks a bit better, or can this rise sort of be considered slightly more permanent? And what is the impact of that, Mark?
Yeah, it's a good question, David. I think certainly on the question of whether this is a temporary or permanent rise, it certainly appears to be on the more permanent side. So it will come in 2025. And clearly there's a reversal of the previous policy, which was to drive down the headline corporate tax rate to 17%. That was already stalled at 19% last year. And we'll never know whether or not the UK would have reduced that to 17% ultimately, and the ultimate success of that. Because I think, like I said earlier, what I think we will now see is more of a trend towards either corporate tax rate freezes or an increase, or a general increase in corporate tax rates. I mean, if we look at the G7 countries, the UK is still has the lowest headline corporate tax rate across the G7. So that includes countries like the US, Japan, France, Germany. So from that perspective, it's still extremely competitive. There are a couple of other measures that I think are important in terms of viewing the UK from a tax competitiveness standpoint. The first of those is R&D and innovation, and Kara just briefly touched upon that. And there is an ongoing consultation in respect of research and development incentives. We've seen Singapore enhancing its own innovation incentives for corporates. So trying to encourage those kind of activities into the UK, I think, will be important. We saw in that respect a relaxation of some immigration measures for high-tech industries. So there is a suggestion that the UK wants to try and attract companies to carry out innovative activities in the UK. So I suspect what we will see as part of the consultation over the next sort of 12 months is ways in which they can improve the attractiveness of their R&D tax incentive regime. And I think if they can manage that, then the UK will remain extremely competitive from a tax standpoint on a global scale.
Great stuff. Thank you very much, Martin. Bringing you in. From a personal tax perspective, the Chancellor mentioned in his speech that the UK had borrowed an additional £408 billion to fund the response to COVID, and that the debt is set to peak around 97% of GDP for next year. From your slides, it looks like, though the main tax measures aren't announced, they're not going to raise that even in a quarter of that by, say, April 2026. Why is that? And what do you think may be coming next?
Yeah, good question. Yeah, at first sight, it doesn't look as though those measures in isolation are going to raise anywhere near the amount that is needed. But I think a couple of things. Clearly, the government is looking to try and grow its way out of this position. Additional tax revenues will come as business succeeds and flourishes, and the measures announced to incentivise businesses in the run up to the corporation tax rise will obviously help with that. And we have, I think, now 60 free trade agreements with other countries. I think the UK is positioning itself, I think, my humble opinion, very, very well for international trade. So I think there's definitely growing our way through this crisis. But of course, these won't be the only announcements that are made. We've got a number of budgets to go before 2025, and I certainly don't think that we've heard the last of tax rises. As I say, I think Mark said it very well earlier that the consultation documents that are going to be published are looking at more long-term measures of restructuring the tax system, and yes, that will help to make it simpler, but it's also going to be designed to make it fairer, to collect greater revenue, and to make sure that burden is shared fairly. So I think what we've seen in the budget is a starting point. There will be more to come, no doubt.
Thank you. And there's a specific question for you, Martin, if we can keep you online, which is, can you advise whether a new UK investment property purchase made through a UK limited company whose directors are non-resident would not be subject to the additional non-resident stamp duty of 2%, assuming that as an investment property would still be subject to accelerated stamp duty addition?
Yeah, sure. So UK residential property purchased by a UK resident company, you'd think that would be fine, wouldn't you? But no, they've thought of that. If either of the directors or all of the directors are not UK residents, under the residence tests within the new stamp duty legislation, I'm afraid that will be subject to the non-resident rates as well as the accelerated rates. So it's a very interesting question. It speaks into a wider question, doesn't it, about whether a company is the right vehicle to be holding UK residential property, and it's certainly become something of a fad to buy properties through that. And there's no right or wrong answer to the question. If you're looking at buying larger portfolios, then yes, I think a good argument can be made. But let's just wait for the consultation documents to come out on the 23rd. We'll see whether or not they do some kind of alignment for tax on personal investment companies. But sadly, in answer to the question, I'm afraid they thought of that, and you would have to pay at the non-resident rates. Thank
you very, very much. Hi, Commissioner. There was a lot around levelling up. I know Mark was talking about the free port piece as well. There was a significant emphasis in the budget on driving growth throughout the UK in some specific areas. Can you provide us with some more details on what that looks like and where some of the incentives are for some foreign direct investment into the UK as well, and where the opportunities are around the partnerships between Singapore and the UK?
Yeah, that's a really great question. And I think for a couple of years now, this government has been absolutely focused on levelling up, and this budget put some flesh on the bones of what they mean by levelling up, I think, with some significant investment behind it. So I think within the budget, they announced 45 new town deals, launching a community ownership fund that will help communities to buy local assets that they want to retain, and they're going to open up the first round of bids for the £4.8 billion levelling up fund, which is to encourage the growth and regeneration within towns across England. I think we've talked about 8 new free ports, and I think Mark mentioned that there will be the ones that were announced are all in England, and I'll run through where they are. But I know that Scotland, Wales and Northern Ireland, who have economic competence in this area, are likely to give thought to this policy area as well. The one in England are in Teesside, where there's already significant Singapore investment, actually, not in Freeport, but around the location of the port. Humber, Felixstowe and Harwich, Thames Gateway, Solent, Plymouth, South Devon, Liverpool and East Midlands Airport. So they're all around the coast of England, and one right in the very middle of England with East Midlands Airport. Devolved nations are also receiving an extra £7.2 billion worth of funding in 2021 and 22 as a result of the budget, and many of the policies announced in the budget are UK-wide, and so there will be bespoke projects delivered also in Scotland, Wales and Northern Ireland. I think there's been a lot of thinking about what are going to be the specialisms of particular regions, and you can see in the landscape in the UK that you'll have a cluster which involves skills, it involves universities, it involves industries and companies that are already based there, and so the government has been thinking really highly about how we can invest even further in those to make sure that they remain really top quality and really attractive investment destinations and investment propositions for companies. So, for example, there is funding in there for the Aberdeen Energy Transition Zone, the North Seas Transition Deal, Global Underwater Hub in Scotland, Global Centre for Rail Excellence, Holyhead Hydrogen Hub in Wales, and accelerating 6 growth deals in Wales and Scotland, and exempting Northern Ireland housing executive from corporation tax. So I think for me, looking at this from a distance, I can see how the benefit of the budget is really intended to play right across the country in quite an exciting way if people are up for looking outside some of the places where they have traditionally invested, possibly in London and the South East.
Thank you so much. And Cara, it feels like you've absolutely framed today's session perfectly well, and just sort of conscious of time. I just want to thank all of the speakers today. High Commissioner, I really appreciate your time. Martin Rimmer, thanks so much indeed. Mark, thank you so much for your time today. I'm going to suggest, because there were only a couple of questions that came through, if there is anything that springs to your mind when you've been dialing in or you log off and there's something that you want to ask, please do put it through to us, and we'll try and ensure we get a response back to you. So thanks again to our fabulous speakers. We really appreciate all of your time, and of course to all of you who joined us in the audience today. And thanks again once again to Select Investors for your continued support of the Chamber and the UK Outlook series. It would be remiss of me not to let you know about some of the Chamber's amazing webinars coming up, and there are 2 in particular that I just want to mention. We've got a member dialogue with the Ministry of Manpower Work Pass Division on the 29th of April. Clearly some of the news around dependence passes and LOCs is something that's very pertinent to the membership, so please do join us for that. And we also have our AGM coming up on the 20th of May, where you'll hear from myself, Richard Warburton, the President, and David Fowler, the Secretary, the Treasurer, and Haslam Priest, and the Secretary, around some of the great things we've been doing over the last 12 months. So really look forward to sharing our updates with you then. You'll receive a feedback form. Please do fill that in. It really helps us to keep shaping the very best agenda for you. And we hope that you took a lot of value out of today's session. So that leaves me to say a big thank you from myself and from the Chamber team. And we look forward to welcoming you at the next event soon. Have a great afternoon ahead.